The Atlanta market isn't just growing, it's compounding. A diverse job engine, steady in growth migration, and a shrinking new supply pipeline are pushing fundamentals back in investors' favors. But headlines can mislead. If you overpay in the wrong submarket, ignore operating costs, or assume yesterday's rent growth, you'll miss the moment, or worse, buy risk you didn't price. Now, what you'll learn in this episode is a clear, data driven case for Atlanta's multifamily outlook, where the demand is coming from, how the capital markets are behaving, the pockets we like and avoid, and how we structure value add deals to capture cash flow and equity growth immediately. So, I actually live in Atlanta. I've spent most of my life in Atlanta, moved around a little bit here and there, but somehow always found myself back in Atlanta. So, obviously I have a bit of a bias for the market. Great culturally. We have an incredible music scene, art scene. We have great restaurants. In fact, the Michelin Guide recently started rating the Atlanta market, one of only a handful in the United States to get those Michelin ratings. So, with so much excellent things going on, let's dig into like the fundamentals and sort of the economic drivers that make Atlanta such a unique and for us a market that we heavily target going forward. Now, we recently closed our first acquisition in the Atlanta market down in Newnan. We'll discuss the South Side a little bit further into the episode, but we just really enjoy the Atlanta market. And as I mentioned in the introduction, all that said, it is submarket driven. So not all markets within Atlanta are created equal. But let's start big. Let's go kind of like level up to the big picture. So what is the Atlanta demand story, and why are people continuing to choose Atlanta as a market to migrate to or to continue to stay in? So number one, migration and jobs. So we've had consistent in migration and broad-based employment drivers. So in other words, we don't have one industry that's sort of dominating. We have logistics, fintech, healthcare, film industry is big in Atlanta, as well as a swath of corporate headquarters, including many that are Fortune 500. Now, speaking of Fortune 500, right here in the Atlanta market, these companies are headquartered. So we've got Home Depot, UPS, Coca-Cola, Delta Airlines, Southern Company, Genuine Parts, Newell Rubbermaid, and others that anchor long cycle demand and supplier ecosystems, which are big drivers of jobs. Now, in terms of the residents, right, what's the value proposition for a resident moving here outside of those employment opportunities? Well, we have a relatively low cost of living compared to, say, our coastal peers, right? So Atlanta market has actually increased in its cost of living, specifically post-pandemic. In fact, prior to the great pandemic, I guess I'll call it the great pandemic, but prior to the pandemic, we had a average home value and a median home value in the high 200s. Post pandemic, that number has risen to 450,000. So, like many markets, Atlanta is supply constrained, and that has driven the home values up. So, all that said, still very much affordable as compared to, say, Los Angeles, where the average and median home value can be north of $1 million, in some pockets over 1.2 million. So, for us, those are some of the main things and kind of that big picture view of Atlanta and why we like this market. Now, in terms of like operating fundamentals, specifically related to multifamily, so occupancy has stabilized and rents are actually back in positive growth territory in 23 and 24 and into 25. Now, that is due to our supply wave that has eased. So, like a lot of markets, a lot of new supply came into the market, but that supply has largely been delivered and is in lease up or has already leased up. And so, due to that supply wave sort of now cresting, we are starting to get back into positive organic rent growth territory. Now, going back to those deliveries, right? So in 2025, absorption improved very nicely, and new starts slowed, right? So we're basically looking at a much more balanced market in 26 and 27 and beyond as that pipeline continues to burn off. Now, once again, I touched on submarkets, but some submarkets had more of that supply than others. So, for example, in Newnan, all the new supply being built is actually rental property, but it's single family homes for rent or townhomes for rent. And because they've been recently constructed, they're subjected to much higher materials costs, land costs, labor costs, even regulatory costs, right? And so the starting rents in many of these properties are 2,400 and up. So our building will compete nicely with a much lower entrance rent, while also providing an exceptional renovated unit that mirrors and matches what they can get in the new unit, but at a much lower cost. Now, in terms of expense pressures, right, taxes, insurance, and payroll still remain a swing factor. In fact, in the state of Georgia, it's sort of interesting, but we have a lot of issues with sort of what I would call the ambulance chaser. So there's just a sort of litigious culture for some reason that's developed in the Atlanta market. And so our insurance costs aren't as high as compared to say Florida, but we have to have some additional riders per our lenders, right? So things like animal attacks and slip and fall cases. So it doesn't drive up our cost dramatically, but it's something we have to be aware of and pencil into these deals. So at the end of the day, underwriting discipline is still matters more than ever, right? So let's look a little bit at the overall sort of like capital market and how money is moving. So in terms of transactions, we've actually seen the bid ask spread. So in other words, what the seller's hoping to sell for and what the bids are coming in at, that spread is starting to shrink. And so we're seeing, more realistic sellers, I would say, coming into the market and advertising their homes. And the majority of the volume of the transactions that have occurred in the past 12 months are actually Class B and C value add deals, which is what we here at Faris Capital Partner does. So that idea that by buying an existing building and forcing appreciation through renovations, many operators like Faris Capital Partners are seeing the opportunity there. Now, in terms of cap rates, we're seeing stabilization across quality assets. Class B and C value add is once again seeing the most buyer depth. And so we're still able to get these deals at an attractive cap rate considering today's market conditions. And while we don't necessarily factor this into our underwriting, we do anticipate that cap rates will start to compress again as the market starts to improve, and some of this new supply burns off and more transaction volume occurs. Now, in terms of debt, the agencies, Fannie and Freddie, are active in this market. We have to be mindful of, the debt service coverage ratio. In other words, what is the mortgage payment compared to our income? And, those things are still very important, but the agencies are liking this market and are putting loans into this market. So basically, there's a lot of good things happening and a lot of movement happening in the marketplace. Now, in terms of submarkets, right? Now, this is going to be super high level. We're not going to really drill down into any sort of specific submarket, but I will talk about a few pockets of progress that we're watching very closely. So basically in Cobb County, as you get close to Truist Park where the Braves play, that stadium is not just a stadium. It's an entire live, work, play, entertainment destination. So the Roxy concert venue is there. There's many sort of other entertainment places there beyond just bars and restaurants. There's like a high-end bowling alley. There's sort of like a country western bar with bull riding, karaoke, and things like that. So it's really become a hub within that area, creating a whole new market that people are wanting to be close to and to be around, whether it's just to catch a Braves game or to enjoy some of the entertainment and restaurants offered in that area. So we call that the Battery Effect. That's the name of that complex around Truist Park. It's really an interesting thing because the Atlanta Braves actually own that entire Battery development. So it's become a huge income opportunity for that baseball team. And now we're starting to see a trend around the country where other professional teams are taking a page from that same playbook. Another pocket we really like is sort of North Fulton. So the Alpharetta, Roswell, Johns Creek, Milton area. There's not a lot of multifamily in Milton, largely none, but there are a few older buildings. We like this pocket because of high income, exceptional schools, and diversified white collar employment. Not a lot of volume in this market, right? So we watch it closely, but it's probably likely a pocket we won't get a lot of opportunities in, but when we get one, we're going to dive on it. We also really like Gwinnett County. It's a diverse market, large population growth, a lot of workforce housing demand, and there's a ton of retail and service density in that area. So the entire Gwinnett market is one that we're keeping a close eye on. There are also some in-town markets that have some interesting things going on, like West Midtown and Old Fourth Ward, but we tend to avoid in town because you tend to get more into high rises. It's not to say we couldn't do it, but we really like more dense, open communities that we can come in and really improve the amenities around it by putting in dog parks and things like that. That's kind of our expertise and sort of our, kind of thing, right? So we'll keep an eye on that market, but it's not necessarily a market we'll see a lot of volume in personally. And then the other area is really the South Side. So a lot of the logistic jobs are down there. There's great connectivity. You're close to the Atlanta airport. In fact, a lot of airport employees, all the way up to to, the airline pilots live in these markets. So Peachtree City, Fayetteville, Newnan are prime examples of that. So we do have to be very cautious on the south side. There are some pockets where you might have higher crime and things like that, but there's some great pockets as well. Newnan being a prime example of that. Low crime, good schools, exceptional population growth, and jobs all around the market, right? So these are just a few that we're looking at. There are other pockets. In fact, if you just sort of look at a map of Atlanta, you'll see 75 and 85, and we call that the V. So sort of within that, that covers Cobb, North Fulton, over to Gwinnett. So I've heard it referred to as the martini glass. So that little pocket there is definitely one we're keeping a close eye on. Now, what are some risks, right? What are some risks in the Atlanta market? So, there are some areas with heavy new supply clusters with a lot of Class A buildings in lease up, particularly in town markets. And so those markets can be challenging, but there's still opportunity to buy a B or C class asset in that market, renovate the units, and sort of create a value option where the resident gets the same upgraded unit that they may get at a newer building, but at a much lower rent. But we still want to be mindful of things like concessions, right? If there's a lot of new supply and lease up, some operators will give 1 or 2 months free rent, and so the headline rent looks good, right? But if you actually look at the economics and sort of how it kind of peels out onto the P&L, it's not quite as strong, and so that will have an impact even on B and C assets, right? Because if somebody gets 2 free months rent, all of a sudden it's not far away maybe from our asking rent. So those supply challenged areas we're definitely shying away from, but keeping a close eye on for future opportunities. Now, in terms of taxes and insurance, I sort of touched on that earlier, but like a lot of municipalities, Atlanta, many markets within Atlanta, cities and counties, froze tax assessments for a few years during the pandemic, and now they're catching up. And so some operators have seen some pretty aggressive increases in their taxes. Now, at Faris Capital Partners, we work with a third-party tax consultant that runs a deep analysis and gives us a good, better, best. We always underwrite to good, hope for best. But at the end of the day, we're working with third parties that can help us better estimate what those taxes will be and what those future taxes will be. In addition, this company will actually go argue for a lower valuation post-closing, which will help us keep our costs down. We pencil in the good number, but if we get that, tax abatement through their, process of review with the county, then that's just gravy. We're excited for that, but we don't underwrite the potential. We only underwrite the real reality of the situation. Touched on insurance already, but something we're super mindful of. Now, in terms of income, right, we want to make sure that whenever we're in an area, and this really applies to any market, that we're buying in an area where the median and average incomes in that area support a 30% or lower rent to income ratio after renovation, right? So whatever the after renovation rent is. Now, most operators will tell you 35, and there are times where we might get to 31, 32 with the right asset, but we like to keep it at 30 because that just signals that as we operate this deal, if say there isn't some income compression or unemployment continues to tick up, we still have plenty of residents in that area that would be apt to choose our property, right? In terms of exit risk, right, it goes back to using conservative cap rates. At the end of the day, nobody can predict the future. No one has a crystal ball. And so you want to make sure your exit cap rates are conservative and not betting on some future cap rate compression. Once again, if that occurs, that should be gravy. That should be the icing on the cake, to mix metaphors. But at the same time, it's just that idea. You got to be very conservative here. Now, our Atlanta playbook, like what is our playbook? It's really no different than our overall playbook and buy box, right? But that 1980s to 2000s garden communities that we can buy below replacement costs that are cash flowing on day one. We institute our 28-day full out transformation where we update all the exterior lighting, rebrand, work on curb appeal, refresh the leasing center, and then start our fast cycle unit upgrades so we can get that additional rent premium through those renovated units as quickly as possible. And then, right kind of really before we close during our due diligence, but certainly right after we close, we really do a full scale lease audit, look at all expenses, make sure our utilities are being billed back properly, working with vendors to negotiate our bids to get the lowest possible cost for the highest quality work, and doing everything we can to drive that NOI from day one. Now, what does this mean for investors, right? So at the end of the day, if you're looking at an investment For me personally, I like deals that cash flow on day one. So in other words, I'm not really attracted to opportunistic investments where the cash flow may come at some point in the future, but it's a repositioning of a property or an outright new development, right? There's just more risk associated there. So for us, we really like that value add. So that cash flow on day one is something as an investor I personally look for. We look for multiple ways to win on a deal, right? So that organic rent growth in that area should be strong. So for our classic units that we're not renovating, or for renewals for current residents, we should be able to get a pretty attractive lease trade out on each renewal. We look for operational gains. So that could be, driving down expenses, sharing some costs across assets. It could also be looking for other income opportunities, like instituting a valet trash program or building storage units like we're doing at our Newnan property. Just ways we can utilize the current asset in its current condition to drive additional income in. And then, of course, just being aware of the downside, right? So for us, we always do fixed rate debt. We always have that 6 months principal and interest in reserve. We always have a 10% contingency on our renovation program, our CapEx. And once again, make sure that day one cash flow never becomes at risk, right? That cash flow continues through the life cycle of the investment. So all that said, we love the Atlanta market. There's a lot of opportunity in the Atlanta market. We are continuing to look in Charleston, Central Florida. We're also exploring some markets in Texas, as well as some additional markets in the Carolinas. So stay tuned to this podcast, or go to fariscapitalpartners.com and sign up for our deal alerts so you can be the first to know. Now, if you've listened to this and you're interested in learning a little bit more, but perhaps you're not ready to get on our deal alerts list, go to fulloutinvesting.com. That's fulloutinvesting.com. We have a sample deal deck on there. You can learn more about our approach to multifamily investing, while also, registering for a time, right, to talk, right? You can book a time with myself or Mark to learn more. We'd love that opportunity to connect and discuss what we're up to. If you've liked this content, please like and subscribe and share with another high net worth investor that you think could benefit from it. We love and believe in you. Keep investing and dreaming big.